Hello everyone, welcome to Blue Dragon Actuals. So today's date is 2nd of July 2022. Today is the birthday of one of my very close friend. Uh, so happy birthday to her. And yeah, moving on. So we'll be covering the ALSM regulation part 2 and also a portion of the appointed actuary regulation. Now appointed actuary regulation, the duties and responsibilities of appointed actuary are kind of very similar, or the work kind of they do has to be kind of related to the valuation of liabilities and ALSM regulation. But one portion of appointed actuary regulation is what are the eligibility criteria and how you can be qualified as an appointed actuary, what are the experience required, and also there is a connection with the peer reviewer in the insurance industry. So I think I'll cover that part and the peer reviewer part in a separate video. However, this part would be related to the finish of the LSM regulation and the duties and obligations of an appointed actuary. So without further delay, let's move on. So yesterday we covered up to the point where the ALSM regulation is also applicable for the financial statement of the reinsurer. And if the insurer is kind of has done the insurance, then for them it would be the benefit amount, or they would be kind of doing the reserving on the sum at risk basis. Now moving on, so this is specifically for additional provisions which will be required for the non-linked or for the unit linked business. Basically for the unit linked business, for unit linked business, the reserves can be split into two parts. One is the unit reserves and the non-unit reserves. Unit reserve, as you all know, is the value of the units, depends on the value of the units by multiplying with the the bid price or the offer price. Both prices are there, right? So unit reserve would be will depend on the value of the units as at the valuation date. And for non-reserves will be calculated using a cash flow discounting method, involving the following cash flows, which will be the expected premiums, if any death benefit is over and above the unit fund, in management charges, which is kind of flowing from the unit fund, fund growth, and the management charges, any guaranteed benefits such as guaranteed maturity amount or guaranteed surrender amount. So if the guaranteed amount are more than the unit fund, then the non-unit fund kind of have to like bear that. And then there would be non-negative residual addition. Now this is the question for today. What do you mean by non-negative residual addition? The answer would be given in tomorrow's video. And also this brings us to the point where I have asked a question yesterday, what was profit and loss appropriation account, right? And it was mentioned that any debit in the profit and loss appropriation account would be kind of given a value 0. If you go back, so this is the valuation of liabilities, and this is the portion. Any debit balance of profit and loss account would be given a value of, and any other fictitious asset other than prepaid expense would be given a value of 0. Why is that the case? So profit and loss appropriation account is an account which is kind of created after the P&L account or the profit and loss account, where P&L in the entries from the profit from the P&L account will be flowing into the profit and loss appropriation account. And the word appropriation itself means distribution or split. So it will be split between different like shareholder or different kind of persons who would be kind of eligible for the profit. This usually it would be the shareholders or the participating policyholders. So that is the profit and loss appropriation account. Now any debit from the profit and loss appropriation account means that it is moving away from the profit and loss appropriation account. So any debit from the profit and loss account would be moving back to the profit and loss account. So that's why it would be kind of treated as an income or asset, and that would not be kind of considered for valuation of asset because of the prudence principle, that if there is any debit which is like that is any money that is flowing for some reason from the profit and loss appropriation account, whose distribution is kind of not like finalized by the end of that year, if that is flowing back into the profit and loss account, then that would be treated as kind of an that will contribute to the profit or loss, but it will not be treated as an asset. And the asset would be like it would be given a value of 0. So that's the concept of profit and loss appropriation account. And moving on to the linked business. So there will be non-negative residual account and additions. And what is non-negative residual addition is something that I expect someone to answer. It's a slightly difficult answer because it involves the concept of something we call shadow fund, or so that's why it is a difficult concept. But let's see if someone would be able to answer that. Now from that part, and it will as we know that any non-future negative cash flows would be appropriately reserved for, and any negative reserves would be zeroized. So that's what we have kind of studied in profit testing chapter of CT5 or CM1, that is zeroization of reserve. Like if there is any negative cash flow, it will be zeroized, and that's why we only keep that. That is the reason that we keep non-negative reserve. So the for the non-unit reserve, that the methodology that we follow is same as the prospective valuation methodology. Like if we use that expected present value of benefit plus expected present value of expense minus expected present value of premium, in this case it would be the expected present value of charges, right? The same method will apply, and the same way we're kind of going to determine the reserve. It is just that the unit reserve portion in the unit link business would be the extra part, right? And that belongs entirely to the policyholder. That is why unit fund is equal to unit reserve. Reserve means liability, and although it is a fund, it belongs completely to the policyholder. That's why it's called unit reserve, and that's why unit fund is equal to unit reserve. Now moving on to the types of the product which we usually don't see, and that product is called the variable linked business. So in Indian scenario, I have not seen this kind of product usually, like when I was part of the core industry as well. And I mean, I think these products are not written. Now variable there are two types of obviously product, that is variable linked business and variable linked products and variable non-linked products. The concept is almost similar to the unit link business. In fact, the closest probably of variable linked business you probably have seen, that is universal life, what we have what we see in Canada or America. Those are the like it is kind of Indian version of universal life. And there is also variable universal life, which will be kind of dependent on this structure. Although variable universal life, one can say that it is more closer to unit link business, but the universal life would be much more closer to the variable linked business. So what is variable linked business or variable linked product? Variable linked product has once again two types of reserve. One is called policy account reserves and gen fund reserve, right? And in unit linked policies, also the non-unit can be called gen fund reserves. So the policy account would show the value or the balance in the policy account, that is whatever the customer has paid. And similarly, the gen fund reserve would be calculated using the discounted cash flow method, and would consider for falling cash flows, which will be expected premiums, if any, death benefits over and above the policy account. In this case, policy account, not the unit fund. Management charges, that is kind of flowing from the policy account growth, and then the management charges, any guaranteed maturity or surrender value, and if there is any non-negative residual additions, and any future negative cash flow would be zeroized. Future negative cash flow the appropriate reserve for, and negative reserves would be zeroized, which is similar to the which is kind of similar to the way the non-unit fund is calculated. And the way you are going to calculate the reserve for the gen fund would be similar to how you calculate the reserve for the non-linked non-participating business, although in this case it is linked, right? In this case it's linked, but the method of calculation would be similar, right? And that would be used for investment norms and for distribution of surplus. So moving on to the last piece, which is, or the second last piece, which is the variable non-linked non-participating business, right? Or variable non-linked. In this case, it is non-linked, variable non-linked product. And the concept is exactly similar. There is a policy account, there will be a gen fund, there will be the balance in the policy account, will be the policy account reserve, and the gen fund would consist of the similar cash flows. However, there are a couple of additions because this is variable non-linked business. So there will be two parts: variable non-linked participating and variable non-linked non-participating. So we have already know about the variable non-linked participating, which will be non-participating, which will be similar to the variable linked business. However, because it is variable non-linked business, the participating part needs to be considered, and that's why we will consider the future bonuses 1 year from the date of valuation, including the terminal bonuses, which is consistent with the valuation rate of interest, tax allowance, if any, and shareholder transfer to the shareholders, provided there is a specified formula between transfer of surplus between the policyholders and the shareholders. So these are the, if you recollect, these are the same points that we considered in the policy cash flows, right, which was the regulation 3 of this regulation only. Policy cash flows also include the same point. These are the cash flows. Now, once again, the gen fund reserve for non-participating non-participating non-linked variable products would be used for would be calculated in the same way for non-participating business, would be used for investment norms and distribution of surplus, and similarly same goes for participating business. And finally, there would be some additional provisions that the appointed actuary need to keep, which they cannot keep for each policies, like each mathematical policies, for each policy they cannot keep mathematical reserves, but they need to keep the aggregate provisions, and this would arise for policies for which extra premium have been sought because of underwriting guidelines, underwriting policies, for reasons such as occupational hazard, geographical limitations, or climatic conditions, or there might be underweight or overweight, especially substandard lives, basically substandard lives for which we require extra premium. Then guarantees which are applicable for group and individual contracts. Then there is options which are available for group and individual contracts. And then there is foreign exchange exposure of the insurance company to the foreign exchange fluctuation, other if any, which would basically mean incurred but not reported claims. By the other part would mean the incurred but not reported claims. And also there would be lapse policies which are called reinstated policies or revived policies, which are currently not in the book, which are currently not in the valuation, but for which liability may arise. So as for example, in India, I think the revival period, I don't remember exactly, but I think it is 5 years. So if a policy lapse after medical underwriting, it can be revived. And if the policy is getting revived, so the last policy will not be in the books, but if it is revived, it became an enforced policy. And so it will, in one quarter, suddenly it will come into the book. So there will be a reserve, and that also causes challenges in analysis of surplus. I have personally faced that challenge. So when we cover the analysis of surplus, we'll cover that portion. So that will be captured in the experience change of the analysis of surplus. So anyways, so that is you also need to kind of reserve for those kind of policies. So these are the policies for which you don't know which policy will be reserved for, right? Which don't know which policy will come from lapse to say a revival state, and that's why you cannot keep policies for each like each of the policies. So you need to keep aggregate reserves. So that would be the entire ALSM regulation. In the previous part, we have considered how we calculate the reserve and how we value the asset, how we determine the value of the assumptions, and also the solvency margin portion. And here we have considered the linked part, linked business part. Now we'll move on to the appointed actuary regulations. And in appointed actuary regulation, we consider the duties and obligations, because that is the part which is kind of related to the ALSM regulations. So appointed actuary should ensure that he got the requisite record for the valuation of asset and liabilities, ensuring that providing advice to the management of the insurers regarding product design, pricing, then insurance contract wording, investment and reinsurance, complying with complying with section 64.5 with regards to the valuation of asset and liability, complying with section 64.5a with regards to the maintenance of control level of solvency margin, that is that 150%. So you can see how the asset liability solvency management regulation is kind of getting linked to the appointed actuary regulation, and this regulation is released in 2017, right? So and the ALSM regulation was released in 2016. So that is kind of the prerequisite for this regulation. You can see from the year as well. So ensuring that the level of ensuring that the solvency level is maintained at all times, advising the management of the insurer when any action has been taken that is prejudice to the interest of the policyholder, that is against the interest of the policyholder, any contravention of the act, compliance with section 21 of the act, to provide additional information to the insurers, ensuring that the pricing policy of the insurer do not depart too much from the underwriting and claims policy. This is a point that if you have studied CP1, there is an what are the kind of advantages of underwriting, or what does underwriting get covered. This is the point that has been covered there, right? Then effective implementation of risk management, effective implementation of the reinsurance arrangement. And now in addition to these responsibilities, herein comes the interest part, where the appointed actuary has to kind of work on the reserve. So the appointed actuary is required to certify the reports that are submitted as per the actual report abstract. So as I mentioned, actual report abstract is a collection of reports, and those are required to be kind of submitted. And that's why to the regulator, appointed actuary needs to certify the mathematical reserves have been calculated as per the actual practice standards, which are released by IAI, and any other guidance released by released by the authority certifying or complying with section 40B and 40C. 40B and 40C is related to expense, and we cover that expense regulation later. So complying with the section 112 with regards to the participating policies and bonus declaration, interim bonus declaration for the policyholders whose bonus have become whose policies have become matured for payout because of reasons such as death or surrender or maturity, right? The appointed actuary also required to consider the policyholder reasonable expectation has been taken into consideration for the participating policyholders who kind of take part in the surplus of the participating fund, provide actual advice for the betterment of the insurance industry and the policyholders, coordinate the calculation of mathematical reserves, ensure the sufficiency of the data and the credibility of the data, inform the board of directors about the appropriateness and the sufficiency of the reserves, ensuring that the mathematical reserves is calculated using models and assumptions which are appropriate as per the opinion of the appointed actuary. And the appointed actuary also needs to kind of inform the authority within a limited time that appointed actuary also needs to inform the authority within a limited time that if there is any contravention to the acts or a number of acts by the management of the insurer, and the contravention is of such nature that it is detrimental to the interest of the policyholders who are the beneficiaries of policies, and also to the beneficiaries are also to the shareholders. And if that any director of the insurer has kind of failed to take such action so as to kind of prevent the appointed actuary in kind of releasing his or her duties or obligations, or the employee of the insurer has taken action so as to prevent the appointed actuary exercising his duties or obligations. And obviously, if an appointed actuary ceases to be an actuary, then that person would not be an appointed actuary. And finally, the appointed actuary needs to follow the generally accepted principles for generally accepted actual principles while discharging his duties and obligations. So these are the I mean, if you have seen the duties and obligations, which are these are the duties of appointed actuary, and you'll see that a lot of portion is kind of related to certification of reserves, and the fact that the appointed actuary is kind of certifying the reserves, the ensuring that the premium does not depart too far from the claims, and or the pricing policy does not depart too far from the claims and underwriting policies. So appointed actuary is kind of looking into the reserve. Appointed actuary is the owner of the reserve, right? And the appointed actuary is the person who is kind of saying that yeah, the reserve is sufficient under all circumstances. He's taking all the ownership. Appointed actuary do have a lot of power, but as in the series of Spider-Man, with great power come great responsibility. The appointed actuary has also a lot of responsibility. We are kind of interested in that 1 crore package, but we can only get that 1 crore package when we can earn a profit of 10 crore for a company, right? So no, otherwise it's a business environment. No one is going to give you 1 crore package just because you have cleared 15 papers. So you need this understanding of reserve and every other aspects that we have kind of covered till now and will be covering in future. So if you like the content, please like, share, and subscribe. If you have any question, please ask in the comment section. And yeah, do stay tuned for the remaining portion of the appointed actuary, that is the eligibility criteria and the peer review, which I'm going to combine. And yeah, and that will be released today. Also, there will be a there will be a announcement. I am thinking of doing some mock interviews, so there will be an announcement regarding that, and that announcement will be kind of posted in LinkedIn tomorrow. So yeah, stay tuned for that, and I will require your help on that. So yeah, let's see and see you in future videos.